All right, Ginger, if you want to go on ahead and start with the introduction.
Yeah, good morning. We know it's tax season and a very busy time for you guys, so thank you for joining us today. Today we have Greg Kennedy, who is a CPA who founded the firm over 30 years ago after working in management for an international CPA firm where he specializes in real estate, banking, and investments. He utilized his specialized experience to build his firm into what it is today, an all-encompassing firm using tax and investment planning approach to assist clients in real estate and financing. The firm has clients all over the United States. In addition to Greg being a CPA, he's also a chartered life underwriter and a retirement income certified professional. Greg received his Bachelor of Science in Accounting from Louisiana Tech University. Ashton, his son, is a CPA responsible for handling all the accounting and payroll services for many business clients throughout Louisiana. He also specializes in real estate taxation, and he is well versed in many strategies utilized by real estate clients. He is a knack for seeking opportunities that others might miss. Ashton received his Bachelor of Science in Accounting from Southeastern Louisiana University. So welcome, guys.
Thank you for having us. Thanks. We're very appreciative, and I've been looking forward to doing this. You're right, it's a busy time of the year, but this is actually a break for us. So we've been looking forward to it. But thanks for that nice introduction. Like she said, basically, Ashton and I are a father-son CPA team here in Baton Rouge. We've been doing this a very long time. And so we have a lot of realtor clients, a lot of real estate investor clients. And so since we work so much in real estate, we hear common questions all the time from real estate investors and realtors. And so we thought that we would put together like a little outline to kind of address some of those common issues, some of those common questions that we hear. So we spoke to many groups throughout the greater Baton Rouge area, and these questions keep popping up. So what we're going to do today briefly is kind of go through an outline, and at the end, we're going to open it up if there are any questions, and we'll have a little Q&A session at the end. So to get started, I want to make the overriding key theme of this presentation is that to stress how you need to be proactive instead of reactive when it comes to your tax planning and your finances. So many people wait till it's too late to do anything to try to plan, and that's never a good idea. So we try to, whoever your CPA is or whoever you work with, you should be actively trying to plan to reduce your taxes, especially since you're realtors and you get a 1099 at the end of the year. Excuse me, there are a lot of tax planning opportunities for you guys, like more than most. So what we're going to do first, one of the main questions we get is, what about travel? Can I write off travel? Can I write off my vacations? And the answer is yes and no. So basically, if you go to a real estate convention or you fly somewhere, you can write off your airfare, your car rentals, your hotel, and 50% of your meals. But that doesn't sound real exciting. So most people say, okay, if I want to go to Orange Beach or I want to go to Destin for a week with my family, is there any way to write that off? So you can't write anything off for your family. However, there is a way that you can write off your portion of the trip. So let's say you're going to go to Florida, and you're a full-time real estate person. You represent real estate investors, so you're always on the prowl looking for new opportunities. So when you get there, look up real estate investment, properties, beach properties, whatever that are for sale, and then contact that actual realtor, the listing agent. Go meet with that realtor, get the flyer, make notes on it, get the business card of the real estate agent, and actually go look at the properties. Take notes and take detailed notes, just like you're going to list a home for sale here in your area. You do that, then you can write off your portion of your trip. So let's say, I'm making up numbers. Let's say you spend $2,000 to rent a beach house, and there's, you and your spouse and 2 kids. Then you could write off your portion of that, which would be $500. and then half of your meals. So that's the best, pretty much the best that you can do to write off a vacation. But a lot of people, if you can schedule a vacation around some places you want to go for continuing education, that's also another good way to do it. So the main thing is to document what you do when you meet with a realtor in this other location, and make sure that you treat it like you're looking to list a property for yourself. You never know, you might actually end up having a client that wants something like that, and you can maybe co-list it with that realtor in Florida. So Ashley's going to talk about some common tax write-offs for realtors. So I'm sure I'm going to accidentally skip over some. This is just a broad view. Every situation's a little different. However, but the more common ones are, and I'm just going to rattle some off, home office deduction, which I will get into here in a minute, vehicle expenses or mileage. I'll get into that here in detail in a minute. Office expense, advertising is a big one. Professional fees, anything you pay a lawyer, a CPA, tax preparer, whoever. Your cell phone, obviously, your home internet, because as we know, realtors work a lot from home. And anything pertaining to that business, travel, like he just talked about, business meals are 50% deductible. Entertainment is not deductible. That comes up a lot. What's the definition of entertainment? That would be, for example, if you buy tickets to an LSU game or Saints game, that's no longer deductible. They changed that a while back because people were abusing that for obvious reasons. So those are a lot of the common ones. Included in the office expense, something that pertains to realtors a lot. If you go buy a new iPad or computer for your home office, that would be deductible 100% in the first year. A lot of times people towards the end of the year will look at things, and if they need to go, if they need more deductions, they'll go buy a laptop, a computer, or a vehicle, which I'll get to here in a minute. So the home office deduction, a lot of returns that we look at, we see that abused quite frequently, and that is a huge red flag with the IRS. So what we like to do for the home office deduction is what's called the safe harbor deduction, which basically means if you were to be audited, if you take the safe harbor deduction, you're guaranteed to not get in trouble for the home office deduction, which they obviously look for since they give you that safe harbor option. So what the safe harbor, the home office deduction is it goes based off the total square footage of your house and also the total square footage of the one room in your house that you use for work. Usually that's a 10 by 10, 11 by 11 room for your home office. And we put it on the tax return, and the IRS has a very complicated formula that they use that it spits out a number of what they think based off of your square footage, what the utility usage and everything else that pertains to that home office, what the deduction should be. So typically, it's not as big of a deduction as most people would assume. Typically it's between like $500 and $1,500 for a deduction, which, don't get me wrong, is a very nice deduction, but a lot of people really that don't do the safe harbor deduction abuse that. And we've seen some crazy stuff on returns that, need to be avoided at all costs. So for the vehicle, as a realtor, probably 99% of our realtors, their biggest expense is going to be vehicle expense or mileage. This gets messed up a lot on tax returns that we review and see. A lot of people, not realtors, but just people in general, self-employed people, whoever does their taxes, they will take vehicle expense and mileage. You cannot do that. So you have to take one or the other. And the catch is once you choose a method, you have to stick with that method for the life of the vehicle. By life of the vehicle, I mean however long you have it. So whenever you go to buy a new vehicle, then you get to decide again, do I want to take mileage or do I want to take actual vehicle expenses? But again, once you choose a method, you have to stick with that for the life of that vehicle. So mileage in 25, if you haven't filed your 25 taxes yet, that is a 70-cent per mile deduction, which can be a very nice deduction. So on 30,000 miles, that's roughly what, $21,000 deduction. The flip side of that, for the actual vehicle expenses, You have obviously your gas, not your spouse, your gas, your car insurance, your car repairs, your Sirius radio, your car washes, anything pertaining to that vehicle would be go into the actual vehicle expense category. And the biggest one with the new tax law that President Trump passed, I guess last year, is the bonus depreciation for vehicles over 6,000 pounds. That went back into effect, whereas that was before he changed the law, that was gradually being phased out, which is a big deal for self-employed individuals. So what that means is, and this would go under the category of actual vehicle expense, depreciation. So if you go and buy an $80,000 vehicle that's over 6,000 pounds, you can deduct 100% of that vehicle if you want to, up to 100% in the first year. So that can be a really big perk, especially for high producing realtors. If their commissions are 200,000, they go buy an $80,000 vehicle before any other expenses, you're already down to 120. So the catch is though that you need to keep that vehicle for at least probably 3 or 4 years, because we often get the question, okay, well, I'll just go buy a vehicle, write it off, and then go trade it in, and next year do the same thing over and over. The IRS is obviously wise to that. So how they kind of combat that is if you go and trade it in too soon or sell it too soon, you have to pick, since you accelerated all that depreciation, you have to pick up a good chunk of that back into income whenever you go to trade that in. So that kind of offsets the depreciation you would get from your second new vehicle. It's kind of a wash. So that's why we recommend 3 to 4 years keeping that vehicle. And, it doesn't have to be 6,000 pounds, obviously. I mean, it does to write it off 100%. But if it's under 6,000, you still get a really good depreciation deduction that typically spans like 3 to 5 years. So it can be very beneficial. The other thing is you don't have to go pay cash for that vehicle. You can finance it. It doesn't have to be a new vehicle. It can be a used vehicle. So there's different ways to do it. But it's not like you have to come out of pocket $80,000 cash to get that $80,000 deduction. So that's something to be aware of. Also, just because you can take 100% of that bonus depreciation doesn't mean you have to. You can spread it out. If you're having a down year, you probably don't want to use all of that depreciation this year. You would want to roll that forward in the years to come when you anticipate that your production is going to continue increasing, because you'll need that deduction more at that point. And that's something that your CPA can help, that you can sit down and kind of weigh the pros and cons of, do I take actual vehicle expense? Do I take mileage? Just because it's more beneficial the first year to depreciate the vehicle, if you're driving 30,000 business miles a year, in the long run, it's probably going to be more beneficial to take mileage and not depreciate the vehicle. So that's something that your CPA can sit down with you and kind of come up with a game plan for that. Did I leave anything off of that?
No, you covered it. So hit the LLCs now.
So LLCs, we get asked this very, very often, not just with realtors, but anyone self-employed. Do I need an LLC? If you ask 10 CPAs, you're probably going to be 50-50. We usually recommend an LLC strictly for liability protection, just because we've seen crazy things happen, especially anytime you go into someone's house. Errors and emissions insurance is probably not going to cover if something crazy happens inside of a house that you're in and you get sued. So, for no other reason, we suggest for asset protection. It's called a limited liability company for a reason, to limit liability. Now, of course, in theory, if you were to get sued and you have an LLC, they can't come after you personally, but, nothing is untouchable.
This is Louisiana.
Yeah, we are in Louisiana. So, but for no other reason, for asset protection. And just because you have an LLC doesn't mean you have to market under that LLC's name. You can still market in your personal name. The LLC is kind of in the background just in case anything were to go awry. And the cost to upkeep that LLC with the Secretary of State is like $30 a year. So it's not a big expense. That's another business expense. But, it's not some huge expense yearly to keep up the LLC. So, but it's not for everybody. Some people see it differently, but that's just our personal opinion on that.
All right, thanks. So
The next topic we want to discuss is S corporations. Should I be an S corporation? Should I stay an LLC? You know,
You have this LLC.
it's, you know, you have to be an LLC at least first, but basically, depending on your income level, in our experience, if your net income, so your 1099 income minus your expenses, your net income is over, say, 45,000 a year, you probably should be taxed as an S corporation. So an S corporation is, it's just a tax designation with the IRS. You're still, you know, if you're set up an LLC, you just convert it to an S corp. You're still an LLC for liability purposes. You're just an S corp, that designation with the IRS for tax purposes only. So why is it a big deal? Well, it's a big deal because, you know, as realtors, you get 1099. You're very well aware that you pay regular income tax and you pay self-employment tax. So most of the tax that you're paying at the end of the year is self-employment tax, because that's 15.3% of your net. That's a big amount. So
On top of your regular income.
yeah,
tax.
so if you're in a 15% tax bracket, you're really paying 30% in tax.
Plus the state.
Yeah, well, plus a state, yeah. So by being an S corp, you can significantly reduce your self-employment taxes. There's some hoops that you got to jump through with the IRS, but it's definitely worth it. So a couple of things that the IRS says you have to do if you have an S corp: you have to pay yourself a reasonable salary. So let's say your net income was, you know, whatever, $80,000. You can't say, oh, my salary for the year was $1,000. That's not reasonable. That's not going to fly. Unfortunately, it's a gray area. They don't really tell you what's reasonable and what's not reasonable. Obviously, you know, that's where we come in, or your CPA comes in to help you make that decision. So you have to pay yourself a reasonable salary, and then your S corp would have to file its own tax return. So the S corp would file a return, but the S corp does not pay income tax itself. It still would flow through to your personal return, just like you're doing now. So just some examples. I ran some quick numbers. These are definitely estimates. Every situation is different. I want to make sure I say that every situation is different. But let's say you had a net income of $60,000. If you were an S corp, that would save you approximately $6,000 in tax. If your net was about $80,000, that would save you about $9,000 in tax. So
Every year.
Yeah, every year. So you can see the more money you make, the more you're going to save. So it's definitely something that we recommend. If you don't do, there's other bells and whistles that you can put on that S corp, you know, depending on your income level. But at a minimum, as long as you do a reasonable salary and file that separate S corp tax return, you can save significant dollars. And we've seen some big, huge savings. I mean, it's not unusual for us to save, you know, 12 to 15,000 a year every year. For someone who was a sole owner LLC, or just on their Schedule C on their personal tax return for their 1099. So it's huge savings. So one of the often overlooked strategies that people don't think of is when you have an S corp, you can put in what's called a solo 401k into your S corp if you're the only employee, and you can do it for your spouse too as well. But if you and your spouse, but really it's for you. So it's just like a 401k plan if you work for somebody else, but it's a solo 401k plan, which means it's simpler to implement, and you can put away a lot of money. So let's say that in that scenario that your net was 80,000, and let's say your salary was $30,000. So out of that 30,000, you could put in about 24,000 pre-tax to make your salary only $6,000 in taxable, 6,000 out of the 30. That 24,000 for your solo 401k contribution goes in pre-tax. Also, your company can match a max of 25% of your gross W-2 wages. So in that situation, that's another $7,500. So you're looking at, you know, $31,000 every year if you choose to put into your solo 401k and get a tax deduction for every penny of it. Another good thing about the solo 401k is you don't have to contribute every year. Since you're the only employee, you don't have to make an employer match. You don't have to contribute if you don't want to, because you might have a down year and you can't afford to, because cash is king and cash flow is everything. If you don't have the cash to do it, you don't have to do it. There's no penalties for not doing it. But I would highly recommend that you look into a solo 401k if you're an S corp, or if you're thinking about becoming an S corp. It's a great way to reduce your taxes and to help fund your retirement. So the next topic we want to talk about real briefly is advantages for realtors who are real estate investors. So we're real big on this. A lot of you guys, you get to see great opportunities. So a lot of times before it hits the market, that you might want to buy for yourself. Well, you know, you guys, most of you are going to be considered real estate professionals. And the definition of real estate professional is you spend 750 or more hours per year in the real estate industry, and 50% of your time is spent in real estate. So probably 100% of you are going to qualify as a real estate professional. So why is that a big deal? It's a big deal for what I'm about to tell you. So before I get to that, make sure on those 750 hours, you don't have to do it if you're a realtor without investments, but if you're a real estate investor, make sure you document your 750 hours. Do it all through the year. Get a calendar. I know it's a pain, but it basically makes you bulletproof if you were to get audited. As long as it's documented, then you got no problems. So that leads to the value of being a real estate investor as well as a realtor is being considered a professional real estate person. You get to deduct all of your losses from real estate investments against your ordinary income. So if your spouse, let's say your spouse makes $100,000 and you have a bunch of properties and you had $100,000 loss on your properties, which would include depreciation. That $100,000 in losses will offset 100% of your spouse's W-2. So your taxable income would be zero. So that's a huge opportunity going forward for real estate professionals. The other great thing is, there's two kinds of, there's long-term real estate and there's the short-term, and I'll get to the short-term in a minute. So a long-term would be more of a buy and hold. Let's say you're going to buy a single family residence, you're going to buy a fourplex, whatever, a duplex, but your intention is to hold that for the long term. If you do that, you can do what's called a cost segregation study. There's professional firms out there that do it, but basically it's a way for them to go in and reallocate the elements of that property. They may segregate the cabinetry or the different parts of the home or the fourplex that can be scheduled for accelerated write-offs. Because real estate investments, if it's residential or multifamily, it's a 27.5-year depreciation write-off. But if you do a cost segregation study, a lot of that can be written off over 5 to 7 years. Well, the 5 to 7 years still qualifies for the bonus depreciation, which means you can write a lot of that off in the first year. So we have a lot of clients, real estate investors that'll come in, they'll go buy one property or a big property every year, do that cost segregation study, get the huge write-off and save their cash and not pay the tax, and then use that money to go buy another one. And then even if you finance the property, it doesn't matter. Yeah, if you do a 1031 exchange, it doesn't matter. There's all kind of bells and whistles that you can do with this as being a real estate professional. So that's a long term. One of the cool things that they just did also was now on the short-term rentals, Airbnb. They have the Trump's tax law put into effect. It's called the STR loophole, STR short-term rental. If you have an Airbnb and your average stay for your guest is 7 days or less, then you qualify for this deduction. So basically, it's a little more involved than what I'm saying. I'm just hitting the highlights of it. But basically, as long as you document and follow all the steps, you can treat that Airbnb as a business instead of passive income. So what does that mean? That means you can write off all the losses in the first year, which is huge. So in real estate, if you're not a professional real estate investor, you're limited to like $25,000 a year max loss if you're actively involved in the property. But by doing Airbnbs, you get much quicker write-offs, and we're seeing more and more of that in the last 2 or 3 years. And now that this tax law is passed, we're going to see more of it. I was shocked. I had no idea you could make so much money with an Airbnb. And if done properly, and I'm kind of amazed at what you can do with that.
So real quick, the other caveat or a caveat with the cost segregation study, you don't want to do a cost segregation study if you plan on holding the property for 3 or 4 years.
Yeah, good point.
You need to plan on holding it for like retirement long term, because if you accelerate, same with the vehicle, you accelerate and front load all that depreciation. If you go and sell that property and don't do a 1031 exchange, and you sell that property 5 years from now, all that depreciation gets picked back up in your gain calculation when you're paying capital gains. So that's not something you want to do if it's just a short-term deal that you're trying to get into, strictly a long-term.
Yeah.
So,
And that brings up another thing. We have a lot of clients that do, flip houses and flip properties. That is considered active. That is not considered, I mean, that's considered an operating business, which is different tax treatment from rental properties. All right, so go ahead, Ashton.
Another question that we get asked often is, can I put my kids on the payroll? How do I get a deduction for my kids? Because we all know with the child tax care credit, it increased by $200 to $2,200. We all know that it costs more than $2,200 to support a child.
Yeah, kids are cheap, right? Look,
Yeah.
I'm looking at it.
All right. So in order to put your kids on the payroll, when I say payroll, I mean W-2. You would need to have an S corp and put them on a W-2, and you can pay them up to, as long as they don't have another job. This is like for younger kids and
Teenagers.
preteen or teenage years, not a 2-year-old, which we've been asked before. So what that means is you can pay them up to like roughly 15, 16,000 a year and them not pay any income tax on that because they don't make enough to pay income tax as a single filer. However, mom and dad are in a much higher tax bracket than your child. So as the S corp owner, you would get to deduct that $15,000 as wages, which lowers your taxable income, your net income on your S corp by $15,000. So if you have 2 kids and you have the cash flow to do it, now you're up to $30,000. So it can be a really good tax strategy in a way for you to get a deduction for something you're not otherwise getting a deduction. Dance, travel ball, cheer, any of that tuition that you're having to pay anyway, you're not getting a tax deduction for, except in Louisiana, you get a tax deduction for the private school tuition. So if you wanted to do it for tuition purposes, now you would be able to get a federal deduction in essence because you're deducting it on your S corp, and you would get a state deduction because that's just the tax law. If you do not have an S corp, you could always send your kid a 1099 and you would deduct that on your realtor expenses as contract labor. Send the kid a 1099. They would, however, have to pick up and pay self-employment taxes on that, which again is 15.3%. My self-employment taxes, that's Social Security and Medicare. If you add those two together, it's 7.65%. And then when you're self-employed, you have to match that. So the 7.65 times 2 is where I'm coming up with a 15.3%. So, we use the tax strategy, like I said, for private school tuition or any extracurricular activities, or if you want to save for your child to go to college, put them on payroll and just have that direct deposit or transferred over to their personal savings account that they don't have access to, obviously, and you're just getting a tax deduction for saving for college.
Yeah.
So did I leave anything? I think I covered that. That's the main benefit. You could also put your spouse on the payroll, like if they're a stay-at-home mom or dad, you could put them on the payroll and get a tax deduction for it. However, again, you'd have to pick up that W-2. So it's mainly strictly for kids that don't make a lot of money.
Yeah, the other thing is if you wanted to, back to the solo 401k, if you wanted to put your spouse on the solo 401k if they don't have a job or they stay home with the kids, even if you paid them, $1,000 a month, $12,000, you could put all of that pre-tax into a 401k for your spouse, and the company would write off the $12,000, and then your spouse, the W-2 would show zero taxable income. So that's another thing we see also.
Yeah.
Okay, and real briefly, I'm gonna jump back on another type of retirement plan that probably most of you are familiar with. It's called a SEP IRA, SEP, S-E-P. That just stands for self-employed pension. I don't know why they don't just say self-employed IRA, but that's just the way it's named. So if you're not an S corp, we see a lot of people doing a SEP IRA. So if you're a sole owner LLC or you're not even an LLC, basically you can put about 25% max of your net income into that each year. 25%. There's a formula to reduce that a little bit for self-employment. So it's like 24 point something percent, but I'd round it up. It's about 25% that you could put in as well. So it doesn't have to be a solo 401k. And there's something else I want to mention is the HSAs, the health savings accounts. So if you, if your spouse has a HSA at their work And if it covers only them, that's fine. You can set up an HSA for yourself as well. And so you could put, the max is, it goes up every year. It's $7 or $8, maybe $8,000 or $9,000. You could put that into your HSA, health savings account, and take a deduction for all of that on your tax return. So I'm a big proponent of the following. A lot of people use their HSA for, okay, I'm just going to, every time I have a medical bill, I'm going to pay it through my HSA. That's fine. But what's even better is to put that HSA in an investment account and put that 8,000 or 9,000 in there every year and don't touch it, and let it grow and save it for, it'll be a supplement. It's not a retirement plan, but when you get old and you need the medical care, you can draw that money out tax-free. So you get the deduction every year going forward as you age, and you get to take that money out tax-free as long as it's used for medical care, medications, doctors, surgery, anything like that. So by investing the money in some kind of growth vehicle, you can really supercharge the amount that you get basically tax-free on the back end. I wanted to mention that. It's a great deduction, and sometimes we forget to talk about that.
So before we open it up for questions, we wanted to give like a bulleted list of the top 5 things to do as a realtor and the top 5 things not to do. Because as I said, we've seen some crazy stuff on people's tax returns that have come to us. So the first one obviously is be proactive, not reactive with your finances.
These are things to do.
Yeah, these are things to do, obviously. So be proactive, not reactive with your finances. If you get with your CPA after year end and say, hey, what do I need to do to save taxes? Your options are very limited as to what you can do. You need to be in constant contact with your CPA or tax professional throughout the year to ask any questions and to, like I said earlier, come up with a game plan, because you want to be proactive, not reactive when it comes to taxes. The other thing, number 2, is document everything, like Greg said earlier, just in case. Anybody can be audited, obviously. If you're audited, documentation is key. They say to save your tax returns for 7 years in a safe place in your records. So a lot of people put them in a shoebox at the top of their closet, out of sight, out of mind. And if the day ever comes where they're audited, they give it to the auditor and say, here, knock yourself out.
You figure it out.
So number 3, when in doubt, call your CPA before making major financial moves. This kind of goes hand in hand with being proactive. We recently, not a realtor, a different self-employed individual, did not tell us about a retirement account that they were opening, a solo 401k. We do their payroll. We had no idea about it. Well, now they're scrambling because the financial advisor did not realize the ramifications of the solo 401k. They way over contributed, and it's created a ripple effect on his tax return to where he's not going to get full credit for the deduction and a lot of different things. So definitely be in contact and ask before you make any major moves. Use your tax savings from these strategies, the S Corp and other tax strategies we went over, to invest in your retirement accounts. Because if you decide after this meeting, hey, I want to convert to an S Corp, I think I can save $10,000 a year. Well, technically, there's $10,000 you just freed up. There's your retirement contribution for the year, because at the end of the day, any amount is good for retirement savings, and it's never too late.
And it's deductible.
And it's deductible if done properly. So number 5, become a real estate investor ASAP for the obvious reasons that Greg went over. We've seen the big benefits on especially on our realtors' tax returns of being a real estate investor. Again, the main thing is going to be the Airbnb, and then also if you wanted to do the cost segregation study, obviously you would need to do a cost seg study to be able to show a $100,000 loss, for example. Hopefully you have a property that doesn't actually lose $100,000 before depreciation. However, if you're a real estate investor, that would be deductible. So Greg's going to go over, before we open it up for questions, the top 5 things not to do.
Okay. 5 top things not to do.
And some of these are our pet peeves.
Yeah. Okay. And I'm not just saying this because I'm a CPA. Well, kind of, yeah, I am CPA. So when it comes to your tax planning and your tax return preparation, use a CPA. Don't use a tax preparer. They are cheaper, way cheaper. They're cheaper for a reason. We have seen just about every client that comes to us that probably 95% of them that used to use a tax preparer that's not a CPA, they come to us, the return is totally screwed up. So if they were to get audited, the IRS can go back 3 years, and they can go back a little further if they suspect fraud. They can go back 3 years and make you go back and pay all the taxes and penalties that you should have paid that year. One of the stories that we laugh about is we had a client that they come in and they these deductions listed on their tax returns that are on their business for real estate that are obviously personal, huge numbers,
House note,
crazy things like that, and you just can't do that. The other thing I'd like to say not to do is don't believe everything you read on the internet or social media, TikTok, about taxes and tax write-offs. We've seen some crazy stuff that's blatantly false, and you run the risk of getting yourself in trouble if you just blindly follow that advice.
or like TikTok, for example, is partially true. You don't, every situation's a little different. So you may have something over here that affects your whole situation, but we have heard from a lot of people, oh, I heard on TikTok I can do this. And like, well, under normal circumstances, yes, you could. However, you have this situation going on that you're not eligible to do that. Yeah. So just be very careful with what you believe on social media.
The other thing not to do is don't, Ashton stressed this earlier, do not flip-flop year to year using actual vehicle expenses versus mileage reimbursement. We see that a lot. That people think, oh, I'm just going to take whichever one is higher for the year. You can't do that.
Or double dip.
Yeah, or take both. Yeah, but a lot of people just, they try to go back and forth between the years to figure out what benefits them the most. You cannot do that. The other thing, pet peeve, is that home office deduction, where we see people try to write off their whole house mortgage. And so that's because I have an office at home, I'm writing off my whole mortgage. It happens a lot, and
you're just asking to get
audited. Right. If you get audited, you got a problem. And the last thing, common sense, but don't assume anything when it comes to your money, your taxes, your finance, your investments. When I say assume, I mean, you listen to what your next door neighbor says, back to the internet thing. You got to be proactive and really research things yourself, or talk to a CPA or a lawyer or a professional to make sure you're doing the right things to keep yourself out of trouble. Because you worked hard in your career to get to where you are. You want to make sure you stay where you are or go higher. You don't want to be, dealing with tax problems from the past.
So what I'm going to do now, I'm going to put our contact information up on the screen. If anyone has any questions about anything that we said today, give us a call, go to our website. That's going to be on here.
Or call your CPA.
Yeah, or call your CPA, and you can contact us through the website if you want. So I am going to, let's see.
You also have a couple questions in the chat already.
Okay, perfect. Give me 1 second. Let me share the screen here with the PowerPoint. Give me 1 second. All right. Does that come up on y'all's end? Laurie, does that come up on your end?
Yes, it's up.
Okay, perfect. So if anyone would like to ask a question, we'll open it up for questions now.
The first question in the chat is, what is the youngest age?
Let me tell you. We get that a lot. Are you talking about for putting a kid on the payroll?
I would assume yes.
That's a gray area. So every situation is different. I can't say the age, but I would not, you're not gonna put your 5-year-old on the payroll. I would think they would, 9 or 10-ish or above. We had somebody, one of our clients in Texas recently, they wanted to put their newborn baby who was like a month old on their payroll. And the lady's like, I'm like, you can't do that. And she's like, well, my baby is cute. Look at my baby. And
the baby model is what they're
the baby model for their clothes said, your baby ain't that cute. So no. So I would probably say 10 or above.
Okay.
Would be.
And then along the same lines, it says, do the kids have to be dependents? Can you pay grandkids?
Yeah, you can pay grandkids. You can pay anybody you want.
Consult your children first.
Yeah. Yeah, you can put your grandkids on there. You could put your best friend, anybody, as long as you're willing to pay that salary, you can do that. So yes, you can get a tax deduction to put that money on payroll for your grandkids. And if for them to spend or for their private school tuition or college or a wedding fund or whatever you want to do. So yes, you can do that as a grandparent.
If marginal on net income, wouldn't an S corp benefit be marginal as well because of the cost involved, such as corporate tax return fee, payroll company fees, corporate filings and fees?
Good question. Very good question. That's why I referred earlier to, generally we say if your net income, net income after expenses is 45,000 or above, it makes sense to be an S corp. Obviously, the higher the number is above that 45, the more sense it makes. If your net income is less than 45 every year, I would say do not convert to an S corp, because by the time you pay the other fees and you do your pay for payroll and you pay for the S corp tax return, it doesn't make sense economically.
But if you're over 40 to 45, in our experience, that's where it's more, you know, it's beneficial even after paying your CPA to do all that, the payroll and everything, it's beneficial. Now, if you're over 40, like you said, that, you know, that's all land you out from there. But one quick thing, before we get to the next question that we forgot to mention, and we get asked this a lot, quarterly estimated payments. So just because you convert to an S corp, or some of y'all are probably already S corps, just because you're an S corp doesn't mean you're getting out of income tax. It's strictly a play on the self-employment tax.
Right.
So I know a lot of people that are just that are not S corps make quarterly estimated payments, and S corp owners. You still want to do that, because technically, if you don't and you owe a chunk at the end of the year, you're going to get a penalty and interest letter from Louisiana and the IRS for not paying in enough during the year, because they see that as their money throughout the year, not yours. So you definitely, we're definitely recommend making quarterly estimated payments, and your CPA can, you know, you can get with them in each quarter and say, hey, I think I profited $20,000. Can you please calculate what you think I should pay? We do that all the time for our clients. So your CPA should be able to do that for you.
The other thing, back to that last question on for an S corp, is it worth it? Like I said, over 45,000, 90% of the time it's worth it. There are a few situations that we've seen where it's worth it when your income is less than that. And that is if your spouse is a high income earner, like they're making a lot of money. Sometimes
30, 35.
we see situations where it makes sense. Every situation is different. It makes sense on their situation alone for the spouse that's making the, you know, less than 45 to be an S corp. I'm not going to get into the details of that, but it's unusual, but it does happen. But as a general rule, over 45,000, there's an economic benefit to it.
If we pay our children through the business, are we required to provide the funds to the child, or can we move the money back into our account? Will the child have to report the payment to the IRS as well?
So, okay, yeah. So you give a W-2 to your child,
which is reported to the IRS.
which goes to the IRS. It's another way to get them into the Social Security system at a young age as well. So you report that, it gets reported to the IRS. The child gets a W-2. In our situation, we file the kid's tax return. We don't charge for it. Your CPA probably won't, but they file a tax return. They show the 15,000, but since it's below the standard deduction for the threshold for being taxable, they're not going to pay any income tax. But you still have to file the return because they got a W-2 and it's been reported to the Social Security Administration and the IRS. And you still get the deduction on your business.
The other caveat to putting a kid or grandkid on payroll, or whoever, if they're young and don't work elsewhere, make sure whoever's doing the payroll that they put them as exempt for federal and state income tax, because there's no point in having federal and state income tax withheld out of their paycheck each week or month whenever you pay them, because they're going to get all that back at the end of the year anyway. So that's, you know, that kind of defeats part of the purpose of putting your kid on payroll. So just make sure they're exempt.
So back to the other part of that question. So we tell most people, if your child is, let's say your child is 10 years old, set up a savings account or something at the bank and pay that money, you know, to them. There's no rule that says you can't transfer that money that went into the kid's savings back to your personal checking account. There's no rule that you can't do that. So some people, if their kids are, you know, teenagers and they pay the private school tuition or whatever out of their kid's account, if the kid has an account, and then, you know, and some people put it in their kid's account and immediately transfer it back to their own account. So their personal account, not their business. So we've seen it done both ways.
If you have an S corp, do you recommend quarterly W-2 payments or are monthly payments better? Can you change this amount quarterly or monthly as well?
Okay, so I'm assuming they're talking about making payments into the IRS.
Yeah.
So for example, obviously you don't have to use us, but the way we do it for our self-employed people, because we run payroll here, is we kind of look at the whole situation to see the spouse, how much they're having withheld out of their W-2. There's different ways to do it. So we have some clients that realtors who we run payroll for, and they want their entire salary because they're high earners to go paid into state and federal income tax each month when we do the payroll. So it just nets down their paycheck to zero and it's just out of sight, out of mind. It comes out of their business account. We remit it to the IRS and to the state. Then at the end of the year on their W-2, said they paid themselves a salary of $80,000. Box 2 on the W-2 for federal income tax withheld is really high because
They don't want to make estimated
they don't want to make estimated payments, or they just want it out of sight, out of mind, like I said, periodically when we run payroll. The other way, and no, there's no right or wrong way to do it. Every situation is different with you and your spouse. However, with the quarterly estimated payments, like I said, you get with your CPA, they help you calculate that amount. That's fine. The other philosophy we see, again, no way is better than any other, is we have some people self-employed that say, I'm not making estimated payments. I'd rather owe $20,000 at the end of the year and pay a little bit of penalty and interest from the IRS and the state, because the money that I'm paying into the IRS, I'm just going to put in an investment account and I'll make more than what the IRS is going to charge me in interest. And we're gonna play that card. The only thing with the quarterly estimated payments, I do recommend it. A lot of realtors, when they get their commissions, they have a separate savings account. In their mind, it's a savings account, but in their mind, it's their tax account. So they take 30%, 35, 20, whatever percentage they decide, and immediately transfer that over. That way there's no surprises at the end of the year. The only downside with the quarterly estimated payments that we saw was during COVID, whenever people made in these huge estimated payments, and then obviously this doesn't pertain as much to real estate because during COVID houses were selling in like an hour, but other self-employed people that made in these big estimated payments, they lost their job, quickly became unemployed overnight. Well, they've paid in all these quarterly payments throughout the year and they're strapped for cash, and there's no way to get that money back until the end of the year when you file your taxes. So that was kind of a wake-up call for a lot of people. I don't recommend owing $20,000 at the end of the year, obviously. I guess if you're very disciplined, that's fine. But life happens and unexpected expenses come up, and they always come up at the most inopportune time, right when taxes are due, your AC goes out or something, and then you're in a bind because now you're gonna have to set up a payment plan with the IRS. So I hope that answers your question. I'm not trying to deflect that question, but there are different ways to do it out of the W-2, quarterly estimated, or no payments at all.
I'll say something too. Also, on your W-2, when I say a reasonable salary, let's say in my example from earlier, I said a salary of $30,000. You do not have to pay the same salary each month. So let's say, 30,000 is like what, $2,500 a month in salary, gross W-2 wages. And let's say you have a month where you didn't make any sales and your cash is tight. You can lower, let's say you can lower your payroll that month to only $500 and then make it back up over the year as your sales resume. So it's not like you're working for some big corporation where your salary is your salary and that's the way it is. You're in control because you're the employer and the employee. So you can fluctuate on your salary from month to month, or week to week if you want. It's because it's all your money as the employer and the employee.
And that's why we recommend if you are an S Corp owner or looking to convert, we always recommend doing your payroll with your CPA, because it makes it a lot easier to contact your CPA and say, hey, I had a slow month, let's bump down my salary, instead of calling a 1-800 number trying to get somebody on the phone every single month.
Yeah.
We have seen that be beneficial.
That could be a disaster.
And on the other hand, if your salary is low and you close a big deal, or things really take off, then you need to immediately contact your CPA or whoever's doing the payroll for you, because you're going to need to bump up your salary to still be reasonable at the end of the year. So it's kind of a balancing act. You take it down as needed, bump it up as needed, but at the end of the year, as long as it's reasonable, you're fine.
The key to all this is to communicate
Yeah.
with your CPA.
Do you have to be an S corp to pay anybody and give them a W-2?
We normally see that only an S corp. So you could be if you're a sole owner LLC, we normally don't see a sole owner LLC member paying someone in a W-2. We normally see that as a 1099, like for contract labor. I guess each situation is different, but normally we see people who are taxed as an S corp given out a W-2 for their employee or whoever's working with them. Does that answer?
What do you think is the biggest missed opportunity that realtors make regarding tax savings?
Very good question. I'm not to sound redundant here, but if you're qualified to be an S corp, being an S corp, because you're paying so much unneeded tax and self-employment tax. Back to the example from earlier, if your net was 60,000, you're going to save at least $6,000 a year. If your net was 80, I think it was like 9,100 a year, a close estimate of what you'll save. Well, over 10 years, even at 6,000 a year, that's $60,000 that you could go buy, go put a down payment on an investment property or put 60,000 into your retirement plan. So that's the biggest thing we see. Also, the other thing is, if you have the means, if you have the cash flow and the finances to do it, is not being a real estate professional and not investing in real estate yourself, because there's so many bells and whistles and there's so many opportunities there for you to create wealth for yourself and cut your taxes at the same time that it's mind-boggling. So I would think those two would be the biggest missed opportunities, so to speak.
And real quick, we didn't touch on it, but we've been getting asked a lot, what are the recent tax changes that affect realtors? What do we need to be looking for? The biggest one is going to be the vehicle, like I talked about, the 100% bonus depreciation. The Airbnb, like Greg talked about. The other one, and this may be kind of small, but most people take the standard deduction on their personal return. Something that's going to go into effect for 26 is, in the past, charitable contributions, you don't, if you take the standard deduction, you in essence, you get credit for it, but not really, you're taking the standard deduction. This year in 26, for a married single person up to $1,000, married couple up to $2,000, if you contribute to charity church or any other charity up to $2,000 for a married couple, even if you take the standard deduction, you still get credit for that on top of that on your taxes. So, if you donate $2,000, depending on your tax bracket, could probably save you $400 or $500 in tax, between $300 and $500 in tax. So, it may seem small, but every little bit helps. That mixed with the child tax care credit increasing by $200.
The other thing is, we didn't mention this, but if you're over 65, there's a $6,000 deduction.
That's for 25, like going forward.
For 25 and going forward. That tax law changed passed in 2025. So if you're married and both you and your spouse are over 65, that's a $12,000 deduction. Now it starts getting phased down based on your income. So if you're at super high levels, it's going to get really phased down. But for most people, they're going to get the $6,000 per person. The other thing is the interest on vehicles, car loans. This is the thing that really set me off on the TikTok. A guy was saying that you could basically write off your whole car note and everything on any car, even if you bought the car 5 years ago, or you're still paying. Just insanity. The law says that if you buy an American-made car in 25 or beyond, a brand new American-made car, not a used car, a brand new American car, and you finance it, you can write off the interest expense on that monthly note. Only the interest. You can write that off on your taxes, which could be a significant deduction. But there's a lot of misinformation out there saying you can just write off everything.
Your existing car you bought 3 years ago, like
a Toyota from Japan. No, you can't. It's got to be an American-made vehicle.
The next question.
There's no other questions in the chat, so unless somebody wants to unmute and ask a question, I don't have any other ones to ask you.
All right. Well, thanks. I appreciate it. We appreciate it. if we touched on anything that you're not quite sure on and you wanted to give us a call, our numbers are on the screen. We'll be glad to answer your questions for, as a courtesy. If we said something that kind of struck a nerve with you or something that you think you might want to do that would benefit you, but you're confused about it and you want clarification, give us a call. We'll be happy to straighten that out for you. But we appreciate the opportunity and thank you guys very much.
Thank y'all for your time today.
All right, have a good week.